When you all know him, that he's a partner in charge of the transfer pricing at PwC, and his CV is already circulated to you. And his subject today is business reorganization issues. You all very well know the importance of this subject, as Mrs. Malati Sridharan has explained you that how the adjustments have been made. So I will not take much of time on the introduction of the subject because everything will be covered by the learned speaker. And before I invite the learned speaker, may I request Yatin Bhai to present a memento as a mark of our love and affection towards Sanjay. Yes, sir, my wishes.
Morning, friends.
Morning.
Okay. So this, I think it's a hot topic, and I think this is the adjustment which is the largest. So if you look at Shell, 15,500, I think it's one of the largest adjustments. So when you see this type of things coming in the paper, the Mint likes to summarize things and just puts it down that these are the total adjustments. I think the criticality is what next? And I was having this discussion with one of our director of international tax, and I said that you have taken up issue of shares. What next will you do? And if you have to do something, then it should be probably the gift of shares, and you can start challenging that even gifts should be at arm's length, probably, because there's nothing left after issue of shares. So I think what I propose to do is, you have the slides with you, but I'm going to focus on some of the key aspects which are really bothering as of date, and how do we really gear ourselves to defend through documentation, through legal arguments, and through proper valuations. I think that's probably the need of the hour, and that's what I wanted to focus. So let's start with the. So the topic given to me is reorganization, but I'm also going to talk about issue of shares, which obviously is not reorganization, but anything which is related to restructuring, issue of shares, and reorganization of the functions of the company is something which I want to take as part of this topic. So if you look at this definition which was introduced, it says that a transaction of business restructuring or reorganization entered into by an enterprise with an associate enterprise, irrespective of the fact that it has a bearing on the profit, income, losses or assets of such enterprises at the time of the transaction or at any future date. So this is the new entry in the definition of international transactions. The impact is that your judgments on Verenberg, Dana Corporation and Emiante, which actually argue that when there is a gift, there is no transfer, because the machinery provisions fail, you cannot compute, there is no cost, you cannot compute capital gains, and accordingly section 45 will not apply. That gets overruled, in my view, with this particular provision which has been introduced. Now if you look at business restructuring definition in the OECD defines business restructuring as redeployment of functions. So when you do redeployment of functions, and let me give you an example. Let's say you are an Indian entrepreneur and you are a pharma company in India. You're selling goods in the domestic market and you are selling goods in the export market. You are an entrepreneur for the export market. You sell goods directly to third parties. All the profits reside in India. Tomorrow, you decide to create a headquarter for international operations. You create a headquarter in Singapore. That the whole of international operations, which means all sales outside India, you want to manage, operate from Singapore. What would you do typically? When Singapore is going to take decisions, you would sell all the goods to Singapore, and Singapore will sell it to third parties because all the risks now Singapore is going to take. And you may probably convert yourself to a contract manufacturer for Singapore because you are no more going to take the risk. Think about this transaction from an accounting standpoint first. What will be the change in accounting? Anyone? Could you imagine any change in the way you will account for your transactions in the books of the Indian company? You were selling to the third parties in overseas markets. Now you're going to sell it to your related party in Singapore. Any? No change, right?
The data will change. Instead of
The data will change, okay. So the data will change and you will reflect, instead of the third party, you will now have to report related party data. So thanks for that. But from the P&L account, nothing changes. You will still have all the costs of manufacturing. And on the sales side, you will still have sales. But the sales price will change. Because when you were selling to the third party, you were selling at the entrepreneurial price 100. But now when you are selling to a Singapore company, which is your related party under a contract manufacturing arrangement, you probably will sell it at 60 or 70, whatever that price is. Because you will sell it at cost plus without any risk. Now, sorry. Can you imagine what has happened in this whole thing? India company's profits is reduced, but what has been the trigger?
Risk has been shifted to Singapore. Risk has been shifted to Singapore.
Very good. Risk has been shifted to Singapore. Now, think about this and tell me, how can you shift risks?
Budgets will be the issue of the Singapore.
Okay, what else? So let's assume market risk, credit risk,
marketing expenses,
everything is moved. Agree. Risk has moved. How do you move risk? I am asking that question. How would you move the risk?
documenting in the agreement.
Documenting in the agreement. Now think about this. That you will document in the agreement that all risks belong to you. Okay? Go back to the attribution of profits to a PE and Article 7. Can you imagine what was that new change which was brought in by the OECD? Can you remember? You remember the definition of KERS was introduced? Key entrepreneurial risk taking functions. And then they removed the words KERS and they brought in the concept of significant people functions. They kept KERS only for the banking transactions. So for the financial services you still have KERS, but for non-financial services it is significant people function. Today's time, if you move risk on paper without moving the function, it will be disregarded. Your GAR talks about it. We don't have to go far. So you cannot move risks on paper. Think about it. Why can't you move risk on paper? I can do that, right? I create a Singapore company. I have 2 employees, and I will, in my contract manufacturing agreement, make it very clear that I am going to manufacture goods for you, and I am going to give it to you at cost plus 15, let's say. You give me my cost plus 15, I don't care. Market risk, marketing expense, credit risk, all that what you say will be with Singapore. But Singapore has 2 people, and the share capital of that company is $2,000. you tell me, is that company having the capacity to bear those risks? So what are the two things? There may be a lot of things, but I just want to get this concept very clear. That what are those two things which will require the risks to reside in that place?
Substance. Commercial substance.
Commercial substance in the form of?
Setup.
Set up in the form of?
Capital.
Very good. And two?
People.
People. It's all about people. Let's do that. It's all about people. If you look at BEPS, it talks about economic activity. Profits should reside where the economic activity is, and economic activity will always be near the people. Now, what are we looking in people? In people, what we are looking at is that just having 100 people in Singapore is not enough. This 100 guys have to have the ability to take business decisions, which are all those entrepreneurial decisions we spoke about, where to market, what to market, whom to sell, what risk to take. That business decisions they should be able to take, and they should be responsible for those decisions. If there is a failure in the market, the CEO in India should hold those guys responsible, not the contract manufacturer. So people who have the ability to assume business risks, which means they have the accountability and responsibility of taking those risks, that people. And then that company have to have the capital to fathom those risks. Because if you have a capital of $2,000 and you say I'm managing an international operations of $1 million, how will you make that argument? These are the fundamentals. Clear? And please ask questions, because I want to focus on some of these areas only in my session today. I have the presentation. I will not miss anything out of the presentation, I promise you. This is the key to this business reorganization. So what Germany did, and they were the first one to identify this. Before even OECD can think about it, OECD was actually in the making of that paper, Business Restructuring, Chapter 9. Germany brought in regulations, and they called it transfer of functions. They did not say transfer of risk. They did not say transfer of assets. They did not say transfer of business. They only said transfer of functions. And functions are performed by people, not by non-people. A non-human being cannot perform functions. We are not talking about automatic vending machine. So, if functions in the form of people transfer to any other location, so what do you do? Let's take back our example, that we actually move all our key business decision makers in India to Singapore. 10 of them are managing my international operations. I take the Singapore visa. They go, I set the office, they start doing business. Now this transfer is such a difficult transfer to catch, because people always move from here and there. And how do you find out that there is a business restructuring? You would just have these 5 people go in Singapore and start operating from there, and you will make a contract manufacturing agreement. How do you catch that? And your accounting will never show. Your accounting will just show 60 rupees. That invisible transfer, I'm just using these words for lack of words. Invisible transfer of profit potential. What is the profit potential? The future profit potential of earning 100 rupees from third parties is transferred in lieu of 60 rupees. Clear? By moving 10 people and by entering into contract manufacturing agreement. And you can go into the tax authorities and keep arguing that 60 rupees is arm's length, because that is what the cost plus 15. But he is not talking about that. He is talking about the moment at which the transfer happens. Now that is what Germany caught. and said, when you transfer functions, it will be called restructuring. Because you're moving profit potential. Would you have done this with a third party? Tell me. 60 rupees. He said, कल से मैं ध्यान रखता हूँ आपका international operations. I will make you contract manufacturing. I will give you committed revenues. 60 rupees you will get every year. Will you give? That is the answer. And that what you will not give is called exit tax in transfer pricing parlance. That you will need to pay some exit tax. Since you are with me till so far, let's move a little further. Tell me, how do you think an exit tax would be computed? And you please get into the shoes of that Indian company who is now giving up the international operations to the Singapore company, and how would you deal with it?
I would say the only correct method would be discounting the future cash
Well,
flow.
we will come to the method in a while. As a businessman, what will you want?
Difference in sales, I mean, 40 rupees and minus expenses relating to marketing and all this thing. So that difference to that extent is the value.
You take 40.
40, I mean, the difference in sale price and the related costs.
The profit which you are missing.
Yeah.
For 1 year?
No,
That
future,
Five
which
years.
is discounted cash flow.
Discounted cash flow. So you will do some valuation.
And also I will figure in what is the prospects of increase in sales.
So mota-moti you will do your valuation, you will apply the discounted cash flow, and you will effectively what you are doing is you are selling your international business, let's put it this way, minus the business which you are retaining in here, which is the contract manufacturing. That is a very, very mota-moti broad principle. There are lots of nuances, I don't want to, but this is the broad thing that it will be charged to exit tax. Then comes the other issues that when you, this is called exit charge. There is nothing like exit charge in income tax. It's a nomenclature used for the purpose of transparency to help understand what we are talking. But the way it will have to be characterized will depend on the laws of the country. So we will have, let's say India gets, in your example, let's say India gets 1,000 rupees, 10 years cash flow with terminal value, whatever, you made it 2,000. Now this 1,000 could be a capital receipt. Clearly it is not a revenue receipt. And you will have to argue whether what will be the cost for the purpose of calculation of capital gains, if any. In Singapore, which pays 1,000 rupees, will it be a capital asset to be enabled to take depreciation in Singapore? Because that's the other side you will have to see. So then those are the consequential parts which will happen. What Germany did, they went one step further. They built in a provision that you will do this discounted cash flow today, and let's say 10 years, and let's say your value was 1,000. But if actual sales are higher than your budgeted sales for discounted cash flow, that difference also will have to bring back to Germany. This is the law only in Germany, fortunately. Which means the 40 rupees will always be taxed in Germany.
What happens if the sales fall down?
So then they will not make a change. That is a normal tax law. that is the question only should not be asked.
It's like those things.
Till the time you have to fill fiscal deficit, it cannot come back. So, this is the Germany. OECD put their mind together. OECD worked hard. And OECD made a point that if there is a transfer of right which gives rise to a profit potential, then only there should be an exit charge. Now that is an OECD perspective. Not necessarily any country will have to follow, because those countries will have to take that law into their country and then it will get followed. We being a observer country, we take what we like and we don't take what we don't like. So that's how it works. But OECD went one step further to say, so there are two parts which OECD did, that if there is a right which is going and that right is entitling you to a profit potential, then that right can give rise to exit charge and you should compute. Then that is a possibility, but otherwise no. And second, if you would have done this with a third party, the third party will never keep giving you the true up that when I 40 pakda tha, but I have done 60, so I will give you 20 back. You sell the business at 1,000, it is gone. Now he will make it 2,000 or he will make it 20,000. You cannot get that money back. So those are the two good things in OECD. If you go by the OECD definition, then there is no right which is transferred. And tell me this interesting point, that why do you feel that there is no right which is being transferred? There is profit potential, but there is no right which is being transferred. Profit potential is there. You are selling the goods at 100 today. You may sell it at 100 tomorrow. You made a point, it can go down to 20, whatever.
Right in the sense means what?
Do you have the right to market in those markets? Do you have an unencumbered right, which means no one can sell pharma goods in those markets? Is that possible? What you are doing is you are selling goods in the open market. You may be able to sell, and tomorrow you may not be able to sell. The market has not promised you. However, if you have committed orders, let's say you have 10 years agreements to sell those generics to Teva and to this company and that company, then there is a right. But you are selling on the basis of anticipation, you are manufacturing on the basis of anticipation of demand, and you are always going to the market and trying to sell your products, then there is no right available. And any other pharma company can go to the same market and sell the same goods and create the market for himself. This principle is debatable because in third party situation also you are not giving him any right. He is buying your company because he feels with this company and those 10 people, he can take this company to 2,000 rupees instead of 1,000 rupees over 10 years. And accordingly, this can be debatable, and there is a possibility that there could be an exit charge. Because when I transfer today, and this is what I feel that the income tax probably thought about, that because today when I transfer, there may not be a loss immediately today. It could probably come in the next year. On the transfer, there may not be a loss because it's a period event. The 40 rupees is accruing over 1 year. Probably that is why they wrote, irrespective of the fact that it has bearing on the profit, income, losses, assets of such enterprise at the time of transaction or at any future. This is why I do. Because sometimes when you do this, there is no immediate effect. And one could, and a legal interpretation could be that one would argue there is nothing lost at the time of the transaction. They are saying, sorry, I am not looking at that. You could lose it in future. So when there is a transfer of functions, along with that the risk automatically will get transferred. Now I'll bring you back to this point that when we argue, and this is going to be my personal view and it's not a PwC view, that when we talk about agency P, and with due respect to Sony Entertainment Television ruling, Bombay High Court, we'll have to see when it goes to Supreme Court what happens. It has taken the principles of Morgan Stanley and said that if the Indian company is at arm's length, there should be no further attribution of profits to the PE. I want to leave you with a thought. Morgan Stanley ruling was in the context of service PE. Sony Entertainment Television ruling is in the context of agency PE. Service PE, you are required to just pay the cost plus. You just add the cost. What did they do smartly? I don't want to run after Morgan Stanley USA. If those costs are sitting in Morgan Stanley India, and then I will get my cost plus on those costs, I'm happy. That is what the ruling says. Agency PE, in the global context, what does it say? That the agent creates a P through his functions. Let's say he concludes contract. Now when the agent concludes contract, who is taking the credit risk? The agent or the principal?
Principal.
In books. Because principal sells the goods to the ultimate consumer. So he is taking the risk because when he doesn't get the money, it is he who is going to have the loss. Because he is selling the goods and he is directly selling. But who decided whom to sell? Now you answer the question. Who is taking the credit risk? Because I decide that I will sell the goods to you, then I am taking the credit risk. On paper you can do anything. Because I am deciding the credit worthiness of yours and then taking the credit risk. You will not pay and there will be a bad debts in the books of the principal. That is different. And that is what the agency PE talks about. That the agent may be arm's length for his agency function. But because he is concluding contracts, he is assuming credit risk for the PE, which is a hypothetical circle in India. And that risk of that credit risk which is sitting in principle somewhere outside has to be brought in. There is no difference, in my view, in the way significant people functions and business restructuring is being discussed, because everything is going down to the people's functions and the people's ability to assume those risks along with those functions. So everything moves with functions. And accordingly, Germany said, if there is transfer of functions, I will only look at that, because once the functions are transferred, the risk automatically will transfer. Because I am not looking at risk transfer on paper, I am looking at risk transfer through the functions of that person. Clear? Okay. That's the definition. I think once that is clear, and if you can apply these principles every time, you will have a very clear view on whether there should be a chargeability, whether there should be no chargeability. But that's how I personally feel is how you look at this particular definition. Any questions so far?
You mentioned about the right, but when there is an internal organization due to the group policy, so it may not be on contract on paper. So the Indian entity would still have the right, but it is not created out of the contractual arrangement, it is created out of the group policy.
I would recommend you to go to YouTube and type Starbucks, Amazon, Google interview by the British Parliament. So the British Parliament called the top 100 companies in the UK, not the finance minister, the Parliament. And the MPs started questioning these guys that you have such a huge economic activity in UK and we have not seen you paying taxes. And then they said, some of them said that we have structured it properly in Ireland. Guys, Parliament guy says, guys, you don't understand this. And then you know what happened. Starbucks actually paid £10 million for which the tax fraternity is unhappy with Starbucks. Why do you go and do such things? You set your transfer pricing right and then pay taxes, or you say that your losses are genuine and accordingly don't pay taxes. Don't do this moral thing. That's a different story. So what I am trying to say is, you may have a contract or you may not have a contract. You have a very clear law in transfer pricing. It says oral arrangements are also covered. And accordingly, it will go by the conduct and not by the. So typical business drivers for your restructuring is you could have you want a profitable growth, it is globalization, you want all manufacturing to happen in one place, you want all distribution probably to happen on a decentralized basis, many reasons, lower cost, and the financial drivers could be that there is high domestic tax rates. You are a US company, your effective tax rate is 38%. You don't want to pay 38% on all your profits of the world. You will want to restructure your organization with substance in a manner, and no one stops you if you really put substance and changed the model in a manner that for the whole worldwide income, you don't pay taxes at 38%. Because if someone is allowing you 17 and you can actually have substance in those countries, why not? So tax incentives, more aggressive tax authorities, could be lots of reasons for this restructuring to ensure that the business is conducted in a right way. So what are the concerns which come up when there is a business restructuring? In a different way I have addressed those. So you have this exit tax, goodwill disposition, local IP. What are the IP issues? Because you will need to give the IP rights also to the Singapore company for the international operations. Because if you don't give those IP rights, then again the royalties for that have to come to India. So in your valuation, you will also have to take the IP into consideration. How would you do this? In today's time, you can strip IP as much as you want to do. So you can say, okay, India IP remains in India, and the non-India IP moves along with this business restructuring with those people to Singapore. You need to terminate some of your agreements which are existing, etc. So that can happen. Substance requirements, PE risk. Where does a PE risk come? PE risk, an example of PE risk is you convert yourself from contract manufacturer to a tool manufacturer. And let's say in India you are doing tooling, and the principal gives you the raw materials free of charge because he just wants you to do tooling. So you will take those goods, you will do the conversion, and you will send the finished goods back. What will your charge be?
Labor.
Only the labor charge and the markup. Early days, goods used to go back to the principal. Current times, goods don't go back to the principal. The principal tells the toller that please ship to Germany, to Brazil, to France, to USA, because those are my customers. I have done the contract with them. You invoice it to me, the labor charge bill should come to me, but you send these goods to all my customers. Till the time those customers are ready to pick up the goods, those goods will remain in the warehouse of the toller. Some of your treaties make a point that if goods are retained in the country of the agency PE clause, habitually maintaining goods for the purpose of delivery to the customers of the principal, it will create a PE. If you do tolling and in the next 5 days you ship the goods, probably you may be able to argue that you do not create PE, because in some of the treaties, goods held for the purpose of processing or tolling does not create a PE. So you have an exclusion clause. But then the second event happens that those goods were remaining in my warehouse for 6 months, and then you shipped it to the customer of the principal. There is a challenge. This new OECD revised draft makes a very good example. There is an example of a company called Carco, and that example has, the OECD is now looking at the globalization, and OECD is saying that there are tollers all around the world, and they have made a point that till the time this toller is not concluding contracts on behalf of the principal, he is just shipping the goods to those countries, he should not create a PE. That is in the revised draft, it is not finalized, but it gives the intention that till the time the toller is only keeping the goods, but he is not doing conclusion of contract. The conclusion of contracts is done by our Singapore company only. You should not create a PE. That is a suggestion. But you have to look at the PEs when you do this transfer of functions, etc. There will be some indirect tax perspective. The one which I just told you could have a situation. It's not easy, I can tell you, to bring goods free of charge in India and then take it out. You have RBI approvals required, you have customs requirement. This thing which comes in the way, I'll tell you, that in the GR form, when you export goods, you have to put the commercial value. So the commercial value will be 100. And in your invoice, you will write 10. Because your labor charges is 10. You only want 10. authorized dealer and customs data in the central computers of the Reserve Bank has to tally. From authorized dealer entry of the GR form, they will take 10, the customs will enter 100, and they will not reconcile. And the Reserve Bank will feel that there is 90 rupees which has not come to India, and it's very difficult to get this approval. I'm telling you, I took 2 years to get one approval from the, and I went actually to the customs office to tell them that you have to put this value because the commercial value can be put in the notes. It is only for your value principles, but the value of the service is only 10. So these are some of the things which have to be seen along with this restructuring. It's not just restructuring, there are lots of things which go along with the restructuring, so I thought I'll just provide that perspective. I'll come to the commercial rationale in the last. When you do the restructuring, for the restructured operations, what is the transfer price? So in our example, contract manufacturing, we will try and keep, let's say, cost plus 15. How are these things dealt with in the OECD countries, non-OECD countries? You are actually creating a principle in a country which is an OECD country. You are a non-OECD country. How does it work? Specific local requirements. The treatment of money exit tax coming into India, exit charge coming to India, and the treatment of the same exit charge in the other country. Above all, there has to be a commercial rationale. If you do not have a commercial rationale, then it's really going to be a challenge. Then there is a tax issue. And I'm telling you that I have seen companies actually move business, international operations outside India, because it's easier to perform those because you have to be near the market. You can't keep traveling every day. So there is a commercial rationale. The important part is that commercial rationale has to be documented somewhere. Because if it is not documented, then how will you demonstrate? So that is the importance of, and that becomes a critical importance when GAR comes into play, that how would you document the commercial rationale? Maybe we'll talk about that in a while. Okay, so that's the definition of business reorganization, business restructuring, whatever you call it, and its impact.
Sanjay bhai,
Yeah.
since we are moving on to the next part, what is the Indian authorities? I understand a lot of adjustments have been done on business restructuring and reorganization this time. So what is their method of calculation as compared to what you explained to us? Are they on similar lines?
So what they are doing is something similar to issue of shares. So I'll talk about that as an example. But the type of business restructuring which we spoke, they are yet to be assessed. The current assessment is going to be AY 11-12. Most of this happened in 11, 12, 13, so we will see. But I can tell you my experience with the APA authority, that we are actually doing this business restructuring and we have taken it to the APA. We said, okay, why get into? So we took 2 transactions to APA. If I have to take my own example, which I am using, it's not the real example, that I am moving my business operations to Singapore. You tell me what should be the exit charge. Let's work it out together. Second, I will do contract manufacturing for Singapore going forward. So what should be the contract manufacturing markup? So both these points I have taken to APA. They are clear that there will be some exit charge. How much? And that will be this negotiation and settlement, valuation, etc. Assessments, we have not seen this type of situation still.
They have done this here.
On a business restructuring of this type, then I am not aware. Sorry.
This year, a lot of assessments have been done.
Okay. Because there are lots of other assessments which have happened for transfer of business, not functions, actual business. So that I will come. Now this is the shell issue, and the revenues contention is that the foreign entity subscribed to shares of its Indian arm at prices much lower than the market price or fair price. Market price of unlisted shares should be through DCF, and DCF method is very subjective. Growth projections and various assumptions actually are providing opportunity to the revenue to challenge. In one of the cases I had seen, and they were not wrong, if you ask me. Tax authority was not wrong. They picked up the chairman's speech. The chairman of the company His speech was available, it's not a secret because he was giving a speech in public forum. And in that speech, he said that in the next 5 years, we are going to grow 3 times. He said that you have a discounted cash flow which is taking 10% growth in the next 5 years. He took the chairman's speech, he took 3 times, and he took that discounted factor. Only 2 things they do, only 2 things, they don't do anything else. They have some of our fellow members who help them for valuation. So they sit outside the office with their laptop. The discounted cash flow is on the screen. This guy tells him, I'm telling you, that take the discounting factor at 10, so he just puts 10, the number changes. Take the growth rate at 30, and you have a new spreadsheet, and you have a new TP order with whatever 1,000 crores. Only 2 things. They don't need to do anything else. But tell me, if the chairman is saying this, tax has to align with business. Business cannot be aligned with tax. If business is going to grow 3 times, then it will grow 3 times. And I give advice to such clients that if you wanted 5 crore rupees of extra funds to come into India, why would you bring 50 crores? You will only bring 5 crores. But you use your chairman's speech of 3 times and calculate, instead of issuing 100 shares, issue 1 share of 5 lakh rupees or 5 crore rupees. Finish the short chapter. There's nothing else. You know, why would you bring 50 crores? Because the tax authority is demanding. You don't only need 5 crores. Your capital outlay for the next 3 years is 5 crores. Matter ends. We don't need disputes. But we have disputes because we didn't have this wisdom what I am having today in 2011 and 12. So this is where the challenge comes. Fortunately, we have Vijay Electricals judgment, which is ulta, where Vijay Electricals is invested in its subsidiary, subscribed to shares. One thing very important in this whole scheme of things, many times I find that we talk about purchase of sales and sale of shares. This is not purchase of shares or sale of shares. This is issue of shares by the company and subscription of shares by the investor. It is as much similar to a proprietor putting 10,000 rupees in his proprietary firm as capital. If you ask me, there is no difference. And that cannot be an international transaction. Fortunately, you have a ruling which says this is not an international transaction. And this ruling is there. This ruling is for old years. I don't remember the years, but you can check it out. That ruling came after capital financing was introduced in Section 92. Capital financing was not introduced in international transaction definition as a new definition. It was brought in to say that it was always understood that capital financing is part of international transaction, which means capital financing, and it is difficult to argue, if you ask me now, that capital financing will not cover issue or subscription. Difficult. And capital financing goes back to 2001, because that's how it is being introduced, clarificatory. But this judgment came for old years, which is before entry of this capital financing, but after entry of this capital financing. So the court had the wisdom to see that this provision is there, it goes back to 2001, and hence it applies to Vijay Electricals, but still, and there is not much mention in the order of this, we have to imply that the provisions on the statute have been considered. And then they have given the ruling. So I would think that this ruling is a very, very strong point for us. The argument now, you had this issue which went into the court, into Vodafone case. Bombay High Court gave 2 months to the DRP. Sorry, the Bombay High Court gave time to the taxpayer to go back to the DRP and get the answer. Because one of the arguments which was made that transfer pricing is a machinery provision, transfer pricing cannot bring chargeability to tax of any new income, and hence the first question to answer is whether issue of shares is chargeable to tax as income. Only then section 92 should apply. Fair point. Tax authorities have to work hard now because that ground was not pushed, and that is what I would suggest, that we have to push the legal grounds first and take our help from our legal colleagues. And you will agree with me that it is important to fight the legal first, because what happens typically, the way we do things, is that we straight away start assuming that it is taxable now. Let's start arguing on valuation. Arey, chairman had not said this and etc. You start a different battle only. Because then both the parties are battling on what should be the right valuation. Whether the valuation is necessary in the first place or not, that is the battle we have to fight. Marketing intangibles, I tell my fellow colleagues, first let's fight that whether the tax authorities have brought anything on record to show that there is a benefit to the. There will be a 265 pages order, and there will be only one line written that because you are spending 20% of AMP and the comparables are spending 5% AMP, you are spending 15% more, there is a benefit to the. This is the assumption. Fight that. That is the fight. Not that whether it should be 15 or 20. I think that's the time to fight that, and legal is a very, very strong ground. That is it taxable? Now, what is the position of the tax department? The tax department, I think, has worked very hard, and I know this because in one of the order I saw the position that they are saying, why is it taxable? So they have said that this is a transfer. Then they got to the definition of transfer. And transfer includes extinguishment and relinquishment. So they've said that from an Indian company, and I'm using Shell as an example, that Shell has relinquished, extinguished the right to receive the fair value of shares. This is how they created the income. Relinquished, extinguished the right to receive the fair value of shares, and hence it is chargeable. They have done this. Now it will go to the courts. We will see. Somewhere they have probably realized, I feel, that this is a weak argument. If you ask me to pass this test, I have to actually relinquish. I have to show something that I have relinquished. Take my example. I want 5 crores. I do the discounted cash flow valuation required by RBI. The RBI valuation comes to 100 rupees per share. I actually issue shares at 100 rupees. I have not relinquished any rights. There is nothing on record to show that I have relinquished the right. You are coming back and telling me that this should have been 1,000 rupees, and accordingly I should have got 50 crore of capital when I only needed 5 crore. So this is going to be a legal battle. Somewhere they think that it is a big one. And there is a new thing which is started, and that is that they have now started issuing notices to some of the foreign companies to say, now it is the investor side. The investee side was the Shell case. Now the investor side, they are saying that you've got a benefit. The shares which are 1,000 rupees worth, you got it at 100. So this 900 will be taxed in your hands under section 224(4). 224 bracket 4. What it says is, the value of any benefit or perquisite, whether convertible into money or not, obtained from a company either by a director or by a person who has a substantial interest in the company, or by a relative of a director, etc. etc. They are trying to use this section from the investor side, probably assuming that the investee side is weak. So this 224(4) is a new battle. I won't get into that, but there are various ways in arguing that there is no benefit, from whom the benefit should come, whether a company is covered or not. There are legal arguments there. But this you will find as a new notices coming to your foreign clients. because it has to go to the investor. So this is an issue relating to, and they have to be tackled differently. And somewhere you will find that 56(2)(7)(a) is also being used, which is the new provision. But go into the details. I personally feel, and I am trying to argue only on a simple fact. The way the law is drafted, the 56(2)(7)(a), unfortunately from a tax authority standpoint, requires 3 parties. Read it properly, you will find that out. It requires 3 parties. We are battling with 2 parties. So the third person is missing. If the third person is missing, then that provision will have a problem of working. So that's a very simple way to deal with that. Now, when we look at, so that was the second section, which was contemporaneous issue of shares, subscription of shares, how do we deal with it? One of the advices, be a little liberal, there is no harm. It's a very, very practical advice. There is no backing to this advice. The only backing is that we don't want protracted litigation. If your discounted cash flow is coming to 100, there's no harm in bringing 150 rupees per share or 200 rupees share. Or how does it matter to you? And if the 56(2)(7)(b) is not applicable to non-residents, that was brought in to curb some other thing which happened in India, that people were transferring income through share premium. That is not applicable when it comes from top to bottom. So what's the harm? You want 5 crores. I would go and say I will issue 1 share of 5 crores. Simple. What's the point of this litigation is what I am thinking, because there is nothing to argue around this. The principles which I want to talk now, this is the third part of my is that when do we apply transfer pricing? If you go to the principles, it's a very clear principle. It's been established now by Vodafone in the Bombay High Court that transfer pricing is a machinery provision. Transfer pricing will not give rise to income. There is separate sections which will give rise to income. The cumulative applicability will be under 4, 5, 6. Those sections when they give rise to income, and if they are with related party, which means it's an international transaction, so it has to fit under the definition of international transaction, then, and or the specified domestic transaction now, so it has to be fitting into one of those, then they will have to be, the income shall be computed having regard to arm's length price. Very clear provision. So if for whatever reasons a transaction is not taxable, and we'll come to a different type of a transaction, but I'm just right now making a generic statement, stay with me on that, then it will not be, transfer pricing will not be applicable. Now I'm going to jump some of these slides because you know the ruling of Tata Corporation, you know the ruling of Amiante, and what they did was that since the machinery provisions were not applicable, the transfer pricing, the machinery provision was not applicable. That is, the income was not chargeable to tax because there was a gift of shares. Now look at this provision. Vandenberg and VNU International BV, this rulings came in the context of capital gains, where if shares were transferred outside and because of the treaty provisions, they were not taxable. So the capital gains tax was exempt because of the treaty provisions, India, Netherlands. Then it should, what is the point of transfer pricing? So what will you do? Whether it is 1,000 or whether it is 10,000 or whether it is 20,000, it is not taxable. So why do you really get into computation? There is no need. That's what came out from the rulings. But then the Castleton ruling came. And the Castleton ruling said that TP provisions do not automatically become inapplicable if there is no liability to tax. And even I was thinking that why did they do that? And it's a very interesting judgment. I would really recommend you to read this judgment after reading Vandenberg. Read the Vandenberg, see the way the language is, and then read Castleton. What does it say? And I am trying to put words now in that judgment so that I am able to tell you my interpretation of this judgment. It says that yes, you may have the Mauritius TD benefit. So if you are selling the shares from a Mauritius company, it may be exempt from capital gains. I have no problem with that. But has it been assessed? Has someone agreed that just because you have a Mauritius company and you have a tax residency certificate, it is exempt? First you file the tax return, then you claim the TD exemption, because there is no exemption for not filing tax return. So first you file the tax return, then you claim the TT exemption. If the TT exemption is available to you, then DB will not apply. Unfortunately, this will happen at the time of assessment, and hence today you will have to maintain documentation. Today you will have to file the accountant report. I am not agreeing, the ruling is saying, I am not agreeing that you have an automatic exemption of not filing accountant report, not applying transfer pricing provisions, because you believe that the provisions, the income is exempt. You have seen there are so many judgments. The company had a tax residency certificate. However, the board meetings were happening in India. And because the board meetings were happening in India, despite the tax residency certificate, I am not remembering, was it in the case of first something? There is a judgment, but because the board meetings were happening in India, the treaty benefit was denied. The question is that hence, as of today, we cannot take a view where the position has to be finalized, whether the income is exempt or not by a tax authority. We cannot take a view that I will not make the judgment. I will not retain the documentation. The better view is retain the documentation, file the accounting report, keep arguing your position that it is not taxable. The minute it is accepted that it is not taxable, the provisions will become redundant, but yes, you will have to maintain. It is not an extraordinary effort. You will anyway do the valuation for RBI purposes or for various other regulatory requirements. So that documentation of valuation is the only documentation required. You don't have to do a function analysis for a share transfer. So what is the harm in keeping that documentation? What is the harm in filing one accountant report? But this is a view. Castleton prevails over Vandenberg, and we need to take cognizance of that. And hence, yeah, sorry.
See, what you are suggesting is very good as a matter of precaution. We should keep it so that वो कहते हैं हम लोग यहाँ की जो है ताकि सनद रहे और वक्त जरूरत काम आए वो अलग चीज़ है. But the basic principle, I am going to the root of the principle, that when I am fully convinced that it is not taxable, then simply because the department can take a different view, I should do all these kind of things.
Fair point. Thank you. So, I think I agree with you that when you have a firm belief, and I would recommend that the firm belief should be in form of a documentation which writes down that why do you have a firm belief that it is not taxable. You have the TRC. I'm using the Mauritius example. You have the board meetings happening in Mauritius. You've done everything which is going to support to get that benefit. You then can take that position and not file the accounting report. And I'm sure that's a very, very good and strong position. But having put all this documentation in place, the precautionary step which I am suggesting is from a standpoint that now you have this new penalty of 2% for non-reporting. Now, I was asking myself how many battles I want to fight. One is I have to fight this battle anyway to get my TT benefit. then I will find the battle that accordingly TP is not applicable. And here if someone has started this penalty provisions and you can have a penalty order and then you go to the courts, I will have this. Maybe I just filed the form and that form 3CB, I put the same position which I am taking, that I have a firm belief that this is not taxable. I have this exemption available and accordingly I am filing this on a conservative basis. Maybe yes, one may want to do that. Unfortunately, the e-filing of 3CB as of today does not provide you any place for notes, etc. So what we do is we actually file a hard copy. But I would go by what you are saying, that if you have a very strong belief, you may take a view that I am not going to apply these provisions, because the consultant continues to make the point that if it is exempt, this exercise will become redundant, but it is saying at what time. So the difference is, at the time of filing return is the position we want to take. They are saying it will come, you will come to know at the time of assessment, which is 3 years down the line. And then there is a penalty provision. So it's a practicality. I think materiality should prevail. If it's a huge material transaction, you want to take a different call.
But suppose for admittance, if I have taken a department certificate, that itself would prove.
That's a very good one. When you take a department certificate.
Yeah. Instead of 50 CP, I would go for department certificate.
That should be enough for you to take that in. That should be enough to take that in. So when you create internal documentation, this should be that the firm belief is on this basis. Further, I have the department certificate. Only thing to be borne in mind is department certificate is provisional. Thank you. So then I don't need to get into all of this. It's all there. Merger 72A, if it is exempt because you've fulfilled all the conditions, the court order has come, it is not taxable, it is tax neutral, transfer pricing will not apply. Very simple. You don't have to apply too much of your money. If it is tax neutral by virtue of 72A, merger will not require transfer pricing. If it is a merger of a different kind, which is taxable, and the transaction is between related parties, then that valuation will be subject to transfer pricing. If it's a demerger, again, if it's tax neutral, it's to the court route, transfer pricing should not apply. Acquisitions, if there is a transaction between related parties, it will apply. Buyback, in my view, it will apply because buyback is a taxable transaction, and then the valuation of buyback could be challenged, and accordingly we have the same issue in buyback as we have the issue of shares. So again, you need to have your robust valuation for the purposes of buyback. So there are exchange control provisions, so all those certificates are required from different valuers, and those are the supporting documentation.
Acquisition, you said TP will not apply or TP will apply?
TP will apply if it is between related parties.
Because here you said in the slide it is written TP, classified provisions will not apply.
Okay, this is, sorry. Yeah, so this is happening, sorry, if you look at this and if you can just make a note there, that it is happening, let's say, under the domestic. So there is a domestic transfer happening. So domestic transfer, the way to look at it is that 40A2 will not cover this transaction. And tax holiday, there are two pieces. Sorry, I have not made change to this slide. So I will clarify, and thanks to you to bring this out. So if it is domestic, then 40A2 will not apply. In tax holiday provisions, there are two provisions, ATIA 8 and ATIA 10. ATIA 8 is inter-unit. Inter-unit is only for goods and services, so it will not apply. ATIA 10 says any business transacted with the party with whom you have a close connection. There, if in my view, if you are transferring a unit, it could get covered because it talks domestic. Because the wordings there is business transacted with party close connection. It's not goods and services, it covers everything, business. So please make that small change. There's one more change I want you to make in capital reduction. So buyback we spoke. Now there is this capital reduction. Capital reduction, I have mentioned transfer pricing provisions will apply, but there is a change which I want to do there. Transfer pricing provisions should not apply. So let's take the first one, in the hands of the company. In the hands of the company, when they are doing a capital reduction, which is higher than the capital value, and you also have the reserves, it will be treated as dividend. And then there will be a dividend distribution tax. One view is that dividend is not covered under transfer pricing. Okay? Even if there could be erosion of tax base going to the intention of transfer pricing, but dividend cannot be chargeable under transfer pricing because section 92 talks about any income. Dividend is not an expenditure of which you take deduction, and in the hands of the shareholder it is not an income. So it is outside the purview of transfer pricing. So DDT, so if someone argues that आप dividend issue नहीं करोगे, so DDT नहीं लगेगा, and accordingly there is erosion of tax base of India. Yes, maybe, but not covered. Because it is not an expenditure taken for the purpose of computing income, and it is not the income in the hands of the shareholder. So please make that change, and I'll send the new slides. But transfer pricing should not apply. Is the rule.
Can we not say that it's a unilateral action by the company, therefore it's not a transaction?
Yeah, you can argue, but I'm saying really the definition of income, there are two pieces. It should be income or it should be deduction for the purpose of computing income. It doesn't classify in any of it. The second one is that where it takes the color of, because when you are giving more than what is there, then it becomes capital, right? When you give, let's say your equity capital is 100 and your reserves are 75, and you are doing a capital reduction of 100. 75 will go to dividends and 25 will go to capital. Now that 25 will get taxed in the hands of the shareholder as capital gains. He will look at his cost and compute the capital gains. Now, ideally it's a taxable transaction in the hands of the shareholder, and it is assuming coming from a company in which he is a related party. We are not talking of individual shareholders, we are talking of 100% subsidies or 51% or 26%. That person, when he gets this and it becomes taxable, it somewhere takes the color of buyback. Similar treatment, capital, but because now you have a different buyback tax, so it may not be the same color. But the question is that does it require a valuation? Because if I am just distributing back that 175, it doesn't require any valuation. I am just agreeing that 25 of the capital I am giving back to you. One view could be that transfer pricing should not apply because there is no requirement of a valuation. You get the point what I am making? So if the capital is 100 and the reserves are 75, and I have decided that we don't need more 100 rupees, we want to give the 100 rupees back to the shareholders, and you go to the court and you do that section 100, etc. That 75 will be dividend and that 25 will be capital. But that 25 doesn't require a valuation. It is just 25% of the face value I am giving back to you. So one good view could be that transfer pricing should not apply. So in both cases you could make that change that transfer pricing should not apply. Sorry for that. So when you have applicability of transfer pricing, what is the principle we are saying? That capital gains on buyback, yes, and capital reduction of shares, we just said that it may not apply. Issue of equity preference shares, we discussed that whether it is a transaction in the first place. We discussed that Vijay Electricals is something which is to our savior. So where the principles of transfer pricing will apply. When will they apply? That clarity we now have. It will apply in cases of taxable transactions. It will apply, but even in case of taxable transactions, the example of capital reduction, it should not apply is the view we should take. Business restructuring, we spoke that it will apply. What do you do for benchmarking? Most of these transactions, most of them will fall under the other method. And under the other method, you will typically use the price earning methodology or the discounted cash flow methodology to calculate those values, because you won't be able to fit them under cup, and cup will be possible if you really have also been doing this transaction with a third party, but more often than not you will find that these transactions are happening only with the related party, and accordingly valuations will become your key points. Commercial rationale in terms of business restructuring is very important to be documented, and I would strongly recommend that the business rationale for any change in the business needs to be documented in the minutes of the board. Because if you create a document for tax purposes, I don't think it will have enough value. And now you have the new provision of section 188 under the Companies Act, which Companies Act 2013, and for listed companies you also have SEBI, which has brought out new regulations and putting more rigor for related party transactions. The biggest challenge is going to be that you have so many related party definitions. The definition of related party is enormous, so many definitions. But because of that Companies Act requirement also, any of these transactions make sense to be minuted in the board, so that you can say that this was all agreed in the board. This is the commercial rationale, this is why we are doing this. It's all documented there in the minutes of the board. Whenever you want, you give that document only. Don't extract or create a new. I think that document, which is the business document, should be the document to say that this is why I did business research. If that document is missing, it is going to be very, very difficult to say that this document was not made for the purpose of assessment, that it will be very difficult to demonstrate that. So I'm telling you from real life experience. Because in related parties, how do you demonstrate negotiation? You don't have to negotiate, you don't have to demonstrate negotiation of prices with related third parties. I can do it at 100, I can do it at 20, no one is going to ask me. But why did you do it at 55 rupees, 50 paisa with related party? Is a big one, and hence the documenting of that whole journey, not the end documentation. Though typically you will find the end documentation. So in my example of business restructuring, the 10 people moves to Singapore, the contract manufacturing agreement for the future transaction will be there. There will be the P documents, there will be the indirect tax documents, there will be this exit tax calculation. But that whole document will be missing, that I have decided to go to Singapore. That document you will never find in the company. Because that document is all verbal and some discussion, and some CEO will have made a note and sent to someone, you will never get that document. It is there. No such company will just send 10 people to Singapore. But you don't know where it is. It's like my tax leader Ketan says that the milk does not come from milkman. The milk comes from the cow. So go to the cow and get the milk, because otherwise you won't find the milk. So I think that is the importance of documenting the journey of negotiation in related parties, whether in business restructuring or whether even in your imports and exports and royalties, any transaction. The journey of negotiation is the key documentation for transfers. On valuation, you have three judgments: Intel, Tally, and Ascendas. All the three make the point that for such transactions, you need to look at different valuation principles. Most of them have said that, so Intel says that you can look at the comparable uncontrolled price method if that is available. The Tally says that excess earning method, and Ascendas says that discounted cash flow is the best method to use.
Fine.
So now I'll take the issue which Hinish Bhai was referring to, that what are the other issues which we are facing around reorganization, but under what situation? So that is something I wanted to give. So let's take the example directly. You have a UK company and you have a Canada company. Globally they merge. They decide globally to merge. They will merge through share swap or whatever. They will use principles like our 72A. So the companies will merge with each other. There will be one company existing. So the shareholders of one company will get the shares of the other company. It's a simple merger. But what happened that both these companies had a back office center in India for their respective requirements. Each one had a back office center in India. When they merged, they said that there is no need for two back office centers. We just need one, and accordingly we create one structure. So in the pink color one, the purple one, that ITS business was transferred to the ITS activity which was in the TICO India. So they just made it one center. Simple, very, very simple. Now the question is, and these are the issues which are coming out, and you find this transaction happening every day. And this is different from the issue of shares. The principles will be same. They will apply valuation, cash flows could be challenged, projection will be challenged, discounting factor will be reduced. The way to increase the price is the same. But when it is applying is this. So here they are arguing that this is 92B2. This is a deemed international transaction, that there was a global arrangement, and because of the global arrangement, there was this transaction which happened. Now, the first thing is, and we have a Kodak judgment from the Mumbai Tribunal, which says that domestic transactions should not get covered under deemed international transaction. If you look at DTC, Direct Expo, it had actually broken this down to make it very clear. The 92B2 section was broken down to make it very clear that domestic transaction would not get covered. But DTC did not see the light of the day, that particular provision. But Kodak came back and said that you need one non-resident. So these are two residents. It should not get covered. But you will still have this challenge coming. So this is where we are finding you will have global merger, you may actually have a global agreement, and then there will be an Indian agreement. I think the most important thing which is to be established here is that the price negotiation and the terms of the arrangement was done by the parties to the agreement. Because if they have, you cannot demonstrate that the parties to the agreement were the parties to the agreement, and the related party actually played the role of negotiating the terms and the price of the arrangement. 92B2 can apply, because that is the precise reason why 92B2 is brought in. That you may deal with a third party, but everything else is done by related party. We will deem that you are transacting with the related party. That is the provision. The only savior in that provision is that if it is domestic, you could take some reliance on Kodak. Otherwise, it is all on the documentation. So, I'll give you a situation so that you can understand where the failure can come, where the weakness of documentation comes. Global deal happens, and let's assume TICO is not in India, TICO is in Germany. Let's assume. So India sells to Germany, TICO Germany, at 100 rupees. The global deal happened at 1000 rupees. TICO sells its business to Germany at 1000 rupees. Now, after 100 rupees. Now, after TICO India, after ARCO India sells its business to TICO Germany at 100, after doing that transaction, it does a valuation to support the transaction. You tell me whether this valuation will have substance or whether this valuation will have a value. The valuation is correct. I am not challenging the valuation. The valuation is done properly. But it is done after you transacted. That is important. Before you transact, you need to have the valuation, because you will have to transact at arm's length price. So how will you know the arm's length price in such transactions? It is agreed that such transaction will be, the arm's length price will be based on valuation, because there is no other comparable price for this. It is an unlisted company or it is an unlisted slump sale. The slump sale is not valued by anyone else. So you value it and then you transfer it. You have a strong case that you negotiate. Actually. So this is, this is one of the bigger other thing which is happening apart from issue of shares. So you typically will now, in my view, deal with three situations. Apart from the exit charge on real transfer of functions, the issue of shares, the share issue, the issue from the subscriber side, which is the 224(4), and this type of issues where you have business sales or transfers of businesses, but because it could become 92B2. So this is the third one. My last section is OECD, business restructuring. But what I'm going to do is just take you through these 4 key aspects and not take the case study, because we'll have the other speaker and we'll have this function which is there next. So what is OECD Chapter 9 talking about in the context of business restructuring? It says that there should be special consideration for this. There should be arm's length compensation for restructuring itself, which is the transaction itself, the restructuring itself, the sending of those 10 people to, or the functions to Singapore, in my example. The remuneration of post-restructured operation, which is the contract manufacturing, and then the recognition of the actual transaction taken. So the points, I'm not taking the case study, but it's almost the same thing which I spoke about. India moving functions to, let's say, Singapore, then India becomes a contract manufacturer. So the profit potential point is compensation required when there is a transfer of rights and or assets. So that is the point we discussed, that whether there is actually a transfer of right which gives rise to the profit potential. No compensation for mere reduction in profit. That is what OECD is saying. But there is one more point in the OECD which I wanted to bring to your attention, that it talks about a concept about what were the options realistically available to the seller. So if the options realistically available to the seller were that it continued its business at 100, it need not have given it at 60, then you have a dilemma that then he could have continued at 100. There was no force on him to become 60. And accordingly, these two concepts have to be read together. The part 2 talks about allocation of risk, and what it says is, and this is a very interesting one, that I will first look at the contract. OECD says that first you should look at only the contract. Go by the legal agreements, don't go beyond that. The second, it says that please look at the conduct. Is the conduct in line with the contract? And if the conduct is not in line with the contract, no problem at all.
Sorry.
No problem. Thank you. So the point is that if contract and conduct don't align, that is the point of time, it should be challenged. And to challenge, you will look at the 2 things which we spoke about was, do the people have the control over those risks? And 2, does that entity have the financial capability to bear those risks? Post restructuring, it should be at arm's length. What it says is, post restructuring should be looked at independent of the transaction of restructuring. If it is contract manufacturing, please look at it as contract manufacturing as you would have looked at any other contract manufacturing. Don't please link that to your existing transaction, the restructuring transaction. So don't de-link them. So that's proposal which you can look at. And the only point I wanted to make before ending, in GAR, you know GAR, so I won't take time, you know when GAR is going to become applicable. It talks about 4 things: not at arm's length, lacks commercial substance, misuse, abuse of the act, not for bona fide purposes. I just wanted to make one point. There are lots of transparency principles you can use to support your GAR so that the GAR doesn't apply. But I just want to make one point, that there is a fundamental difference in bona fide purpose and commercial substance. The bona fide purpose will apply that why are you doing this transaction? Why are you moving your international operations to Singapore, in my example? So if you are moving your international operations to Singapore, what is that bona fide purpose for which you are doing? You will have the purpose that, okay, I want to operate the international operations from Singapore. So you will have all those, but that is the bona fide purpose. After you have a bona fide purpose to move it to Singapore, does Singapore have those people to bear those risks, and do they have the financial capability to bear that risk? Is the commercial substance. More often than not, you will find economic rationale, commercial substance, business purpose, they are used interchangeably. I just wanted to make a point that it should not be confused. The purpose is the reason to move, and the commercial substance is the reason to support your transfer pricing post restructure. Management and tax team need to work continuously on the same platform. Public documents, website, annual accounts, obligations, chairman's speech have to be considered, and need to have clearly dispute resolution strategies. Many a times this business restructuring happens. Business restructuring happens with a country with whom we do not have a treaty. And then you only have the tribunal and the High Court of India. Because if you don't have a treaty, you cannot go for a mutual agreement procedure. So it is important that when the restructuring is happening, you have to keep in mind that if this issue goes into litigation, will I have the ability to use the treaty? With that, I will end if there's any questions, otherwise, let's end it off.
If you have any questions, we'll take it offline. Thank you.
First of all, I take this privilege of welcoming Shri Patil Sahib and Mrs. and Mr. Vice Trivedi sir. Now coming to the pleasant task, President Yatin, Chairman Paresh Bhai, dear fellow participants, you all will agree with me that Sanjay Bhai took us through some of the intricacies relating to business reorganization in a simple way, thereby generating some amount of discussion on various issues. So we are very grateful to you for sparing of valuable time and addressing the participants. I, on my behalf and behalf of all present here, propose a very well-deserved vote of thanks and request you to now break for some time and then we'll be assembled.